today, we're looking at something fascinating, maybe surprisingly connected. The auto aftermarket and, well, your car insurance bill. We're peeling back the layers, trying to understand how things like trade policy, industry changes, and even fixing your car, how it all comes together in your daily life.
Exactly. That's the mission today. We want to connect these different threads,
Yeah.
trade tariffs, changing regulations, even this basic question of who gets to fix your car and show how they have real direct effects on you. We've been digging into reports from MEMA aftermarket suppliers, looking at new research on repair costs, insurance premiums, really trying to pull out the key stuff for you.
Okay, let's unpack this then. Let's start with the aftermarket suppliers. These are the folks making the parts, the tools, basically everything that keeps most of our cars running. So, what's the biggest thing they're wrestling with right now? What's the major headache?
Well, one thing comes through loud and clear from our sources, especially from Paul McCarthy at MEMA Aftermarket Suppliers. He's been really direct. He says trade tariffs are the #1 policy issue for the industry. He even calls them body blows.
Body blows. Wow, that's strong language.
Yeah, and he says it's not an exaggeration. These aren't just small costs. They're draining money, pulling focus away from needed innovation, and causing huge practical problems like inventory they can't sell, major cash flow issues, and even thinking about the massive cost of moving manufacturing back here, reshoring. It really hits their basic business.
Okay, body blows definitely paints a picture. But how fast does that pain, trickle down to us, the consumers? If my local shop can't get parts easily, that's my car off the road, right? My schedule, my wallet.
That's the connection. Exactly. McCarthy points out the aftermarket is what most impacts consumers' pocketbooks in Main Street America.
Mm.
And think about this stat. 95% of Americans in any year are using the repair market, not buying a new car. So when tariffs make brake pads or sensors or whatever more expensive, that cost eventually lands on you at the shop, at the dealer service center. The supplier's problem becomes your higher bill.
Right. And MEMA representing these suppliers, they're not just sitting back, they're actively pushing back with government agencies. What are they actually achieving?
Oh, yeah, they've been very active, talking to Commerce, Treasury, the National Economic Council, the VP's office, lots of meetings. And they have gotten some important wins. Like they kept the USMCA exemption. That's the US-Mexico-Canada deal, which is huge for parts moving across North America without tariffs.
That's pretty significant.
It is. They also got rules changed so tariffs don't stack up, paying a tariff on a component. Then again, when it's in a bigger part, that prevents costs from multiplying. They also managed to delay some really burdensome U.S. content tracking rules and made sure commercial truck parts weren't hit by auto tariffs. But even with these wins, the overall tariff burden is still really heavy, really complex for suppliers.
Sounds like a tough fight, even with those wins. And this next bit from MEMA's survey back in August, it's kind of shocking. Get this. 42% of suppliers said they don't expect to make money in 2025 because of these tariff issues. Nearly half the industry potentially unprofitable. What happens then?
It's a really grim forecast, yeah. And the consequences spread out. Companies under that kind of pressure have to make tough calls. So we're seeing them cut back on capital spending, less investment in new factories, new equipment. They're spending less on R&D, which hits future innovation, new product development. And sometimes they have to scale back production, too. It's like they're hunkering down, which slows everything down for the whole sector.
So basically, innovation gets put on the back burner while they just try to survive. That feels like a loss for everyone, especially with cars getting so much more technical.
It really is. Paul McCarthy actually compared it to the pandemic, saying these tariff fights are stalling tech progress just like COVID did. Instead of pouring resources into EV parts or advanced safety tech or better engines, they're diverting money and people to just manage tariffs, lobby, find new suppliers, often more expensive ones. It's a drag on automotive innovation overall.
Okay, so suppliers are definitely feeling the squeeze. Financial pressure, stalled innovation, constant tariff battles. Now let's make that pivot. How does this connect directly to your wallet, specifically through rising car insurance costs? It's a link people might not immediately make.
Oh, it's a very direct link. Cause and effect, really. Tariffs on auto parts mean those parts cost more. Simple as that. So when an insurer has to pay a claim for a repair, that claim costs more because the parts cost more. A fender, a headlight, maybe a complex sensor. The body shop pays more, so the insurer pays more. And guess what? Those higher claim costs, they get baked into the premiums we all pay later on. It's basic economics. Plus, think about recent trade deals. We're seeing like 15% tariffs on cars and parts from places like Japan, South Korea, Germany.
And those aren't small players in the parts world.
Not at all. Japan's the 4th biggest exporter of parts to the U.S. South Korea's 5th. Germany 6th. So these tariffs hit a huge chunk of the parts coming in.
So it's not just a simple fender replacement cost going up. It could be these really complex electronic parts, right? The sensors, the computers in the car, and sometimes fixing those needs special tools, special software, which might push independent shops towards more expensive dealership parts.
Exactly. That can happen too. It might mean the insurer pays more, not just for the part, but maybe for longer repair times because of these issues, these bottlenecks. All of that feeds into policy costs.
And it's not just tariffs, is it? There are other things pushing premiums up too.
Right. You've got the broader economy, general inflation. It cooled off a bit, but it's actually ticked up again since April. And then there's extreme weather. We're seeing more intense fires, floods, big storms. Every time one of those happens, there's a wave of insurance claims. That puts a strain on insurers too, adding to the upward pressure on what we all pay. It's like a perfect storm, really.
Yeah, I think we all know that feeling when the insurance renewal arrives. But this discussion really helps, pull back the curtain on why those numbers are climbing. So what's the latest research saying? Where are premiums actually heading?
Well, Insurify just put out some new research with pretty detailed projections. They're forecasting the national average for full coverage to go up about 4% by the end of 2025. That would put the average around $2,402 a year. But, and this is important, if these tariffs keep biting and insurers face bigger losses, that increase could jump to 7%. That pushes the average annual premium up to $2,472.
Wow, that's a noticeable difference.
It really is for a lot of households.
And it varies a lot by state, right? Can you give us some examples to make it more concrete for people listening?
Yeah, definitely. The Insurify data shows some big projected jumps in certain states like Rhode Island, Michigan, Maine, D.C., Delaware.
Yeah.
But they're all looking at potentially 12% or higher increases.
Oh.
And if those tariff impacts really hit insurers hard, it could be 15% or more in those places. That's a hefty increase in 1 year.
Ouch. Any particularly expensive states getting hit hard?
Well, look at Maryland. They were already averaging over $4,000 a year back in June, 4,093 jowls. With a full tariff impact factored in, Insurify projects that could hit $4,358 by the end of next year. That's a lot.
That is seriously steep. And what about Florida? I know their market is always volatile.
Florida's interesting. Rates actually dropped there about 8% in the first half of this year, which was good news for them. But the projection to the second half of 2025 is that they'll see the biggest increase, 7%, pushing the average back up to 3,107 towers. And that's even without adding extra tariff pain. Just shows how quickly things can swing.
So big variations. Are there any states where costs might stay relatively low?
Yeah, there's definitely contrast. Look at New Hampshire. Even with tariffs factored in, their costs are projected to stay much lower, around $1,038. It really shows how local factors, regulations, population density, things like that, can buffer or amplify these national trends.
Okay, so we've really unpacked that double whammy, tariffs hitting suppliers,
Yeah.
and that pressure translating into higher insurance bills for you. Let's shift gears a bit. There's another big change happening that affects the kind of car you might buy and maybe how long you can keep it running. What's going on there?
This is a really interesting development tied to major shifts in regulations. Essentially, there's been a rollback of federal penalties related to greenhouse gas emissions in fuel economy standards. Historically, those penalties acted like a strong nudge, maybe even a constraint, pushing car makers towards certain engine types, even if consumers wanted something else. Paul McCarthy made a striking point about this. He said something like, "For the first time since Richard Nixon was president, consumers can buy whatever vehicle powertrain they really want without some sort of regulatory constraint."
Wow, since Nixon, that's a huge historical shift. So fewer constraints.
Yeah.
What does that mean for the market? Could it slow down the EV push?
It could, yeah. At least in the short term, it might cool the jets on the really rapid EV adoption curve we've been seeing. Manufacturers might feel less pressure to push EVs so hard, especially where maybe demand isn't quite there yet or the charging infrastructure isn't fully built out.
Yeah.
But, and this is key for the aftermarket folks we've been talking about, it probably means hybrids and good old internal combustion engine vehicles stick around longer. Their lifespan gets extended.
Which is good news for the repair shops and part suppliers.
Exactly. For the aftermarket, it potentially means their market stays larger for longer, as they say. More options for you at the dealership, maybe, and your current car might have a longer, useful life.
Okay, so regulations might affect what you buy, but there's another big fight impacting how long you can actually own and fix that car. That's the right to repair battle, right?
Yes, and this is a massive focus for MEMA. They've said it's the biggest legislative investment they've made in their entire 121-year history. The core idea behind federal right to repair is pretty simple. making sure that you, the owner, and independent repair shops have access to the same tools, the same manuals, the same parts, the same data that the car dealerships get.
It sounds like common sense. If I own the car, shouldn't I or my chosen mechanic be able to fix it? What's stopping that now? What are the hurdles?
That's the gut feeling, yeah. But modern cars are basically rolling computers. Fixing them often requires special software, proprietary diagnostic tools just to figure out what's wrong, let alone fix it. Automakers often keep tight control over that stuff, the tools, the software, even the data your car generates. They cite reasons like protecting their technology, safety, cybersecurity.
Which pushes you back to the dealership.
Often, yeah. Which usually means higher costs and fewer options for you. Yeah. So this legislation aims to mandate that manufacturers provide access, non-proprietary access to that crucial information, software, and the physical parts needed for repairs.
So it's not just about getting a replacement bumper, it's about accessing the car's digital systems. This feels like a really fundamental question about ownership in the digital age. Who really owns the car's data? What happens if this legislation doesn't pass?
Absolutely, it's a question of control. If right to repair fails, you can see that restricted access just get tighter and tighter. Repair costs could keep climbing because there's less competition.
Yeah.
You might wait longer for repairs. Maybe cars even become obsolete sooner because independent shops just can't fix them. It really shifts the power to the car manufacturers and limits your ability to maintain, maybe even modify, the vehicle you paid for. It impacts the car's lifespan, your freedom to choose a mechanic. It hits your long-term cost of ownership directly.
Wow. Okay, what a deep dive today. We've covered a lot of ground, from tariff squeezing auto parts suppliers and how that ripples out to your insurance bill, all the way through these big regulatory changes, opening up vehicle choices, and this crucial fight over the right to repair, which could really change what it means to own a car.
Yeah, all these things might seem separate, but they're completely tangled together. They directly shape how much it costs to own and run a vehicle and what choices you actually have as a consumer. It's definitely complex, but understanding these links is, I think, really key as transportation keeps evolving, no matter what kind of car you drive.
Absolutely. So let's leave you with this thought to chew on. As cars get smarter, more connected, more software-driven, how will these ongoing fights over money, rules, and digital access fundamentally change what owning a car even means in the years ahead? And maybe more importantly, what choices will you really have in keeping your vehicle on the road and, ultimately, under your control? We'll see you next time on The Deep Dive.